Yeah, so we have an interesting and hopefully insightful conversation here. Going to talk a little bit from the hoodie side, some of the suit side, and kind of find our happy medium. Just to kind of offer you guys a mental scaffolding of how the conversation will be broken down. We'll talk about some of the DeFi ideals, kind of how they're manifested in both on and off-chain settings. What do we mean by TradFi integration, and like what does this actually look like? And ultimately, where do they meet each other? Where are the sacrifices that we're going to have to make on both sides? But before we kind of dive in, I'll let our two panelists introduce themselves. So can you guys just give us a quick TLDR? What are you working on? Where have you been? And what do you do?
I guess I can start. So hi, I'm Sam MacPherson. I work at Phoenix Labs, and we're a dev shop that's focused on building Spark. Spark is a part of the Sky, formerly known as MakerDAO ecosystem, and we're supporting the USDS stablecoin, which is the largest decentralized stablecoin in DeFi, at just under 6 billion in total deposits right now. So what we do at Spark, we have our initial product that we put out in May 2023 was a money market, an on-chain money market. So this would be for people who want to take ETH, Bitcoin, or derivatives of those assets, and then they go leverage long on it is usually the use case, so they can borrow the stablecoin and then lever up. More recently, we're transitioning into just general liquidity provisioning across all of DeFi. So this involves hooking into all the other lending markets and opportunities on chain. So from the DeFi perspective, this is other money markets like Aave, or more recently like Morpho. But it also involves going into CeFi lending. So this is newer products like Athena, where we are able to allocate capital to the Athena USDE token. So this is basically allocating money to a cash and carry trade on centralized exchanges, so that then that liquidity can then be forwarded and provide liquidity for perpetual futures users to, again, lever up on ETH and Bitcoin usually. And then the other piece of this, which is more relevant for this conference, we allocate to real-world assets, so specifically T-bills. Historically, this has been done off-chain. Maker was a pioneer in the RWA space, and right now the balance sheet has about 1.5 billion in stable coins. This is USDC, and about 1.6 billion in off-chain treasury bills. And with the tokenization Grand Prix, maybe some of you have heard of this. The plan is to allocate 1 billion into tokenized treasury bills. This is moving things forward. Instead of having this off-chain accounting system, we move it into tokenized products on-chain so that people have full visibility into the entire balance sheet of the USDS stablecoin.
Yeah, my name's Lucas, co-founder of Centrifuge. I think maybe to tie a bit into our shared history, like the first DeFi protocol to really onboard real-world assets was Maker. Actually, the funny thing is that from the very, very early days, this was always a goal. Everyone knew that a stablecoin really needed to have truly diversified collateral. And so in 2020, we did a first pilot with Maker, and then 21 actually we had the first DAI backed by assets that were issued on Centrifuge. So like fast forward, right? Real world assets is what we're all talking about today. It's what we've been kind of focused on building and also really focused on making interoperable with DeFi, because ultimately the token itself is not enough. Like you need to have users that actually want to do something with these tokens, and that is Maker, now Sky, and other DeFi protocols that we've worked very closely with on kind of building legal structure, infrastructure, governance processes, right, to actually onboard these assets.
Cool, yeah, I think that's a good kind of jumping off point to open up the discussion around what are the DeFi ideals that we're kind of building around. But let's kind of focus on how these ideals have evolved. Obviously, Centrifuge and Maker have been around when DeFi really wasn't what it is today, a lot of it unproven, RWA is not real. So can you guys kind of talk about what the ideals were maybe 5, 6 years ago compared to where they are today, and kind of how they're manifesting themselves either in kind of on-chain or off-chain infrastructures, applications, or however it might be?
Okay. Yeah, so I don't know if it's really changed all that much. I think like the vision, at least, I think, DeFi there's a lot of people in DeFi. So like everybody has their own vision for the way things should go. But for me, like DeFi isn't even possible without real world assets. Like the original real world asset stablecoins are now one of the most killer use cases in blockchains. And the main use cases of DeFi are, trading assets and lending. And you can't do lending without stable coins. And trading assets, I guess you can do that to a certain degree. But really all this is enabled by real-world assets at a large scale. And so, yeah, the vision for me is to just keep expanding the set of assets that are available to utilize within DeFi to unlock capital efficiency, transparency, auditability with the entire loan supply chain, such that we don't run into the issues that we saw in traditional finance that usually come down to some like opaqueness or fraud or things like this. I really think we can eliminate a lot of these issues with traditional finance by just putting literally every asset on chain. So that's the future I envision.
So I think there's two shifts, and maybe just also DeFi becoming a bit more mature. The first one is that in the early days, I think, and this is still a problem we really struggle with, the only assets that people were looking at were like extremely liquid, short term. Everything is like instant, right? Like Spark Lend is an overnight like money market. There's no maturity in any of this today. And I think that is something that has to come, and that in traditional finance is actually very common, right? Like different maturities, different terms, and we're still kind of working towards that. I think the other change, and I think that we're much further along, in the very early days, a lot of the DeFi protocols were just like, yeah, we're going to use smart contracts for everything, and everything's going to be on chain. And like really, there was almost a bit of an ignorance around like what the off-chain world looked like, what kind of trading firms you needed to have, what the infrastructure looked like for that, right? And actually, like today, you see a lot of these DeFi protocols like think about this much more holistically. Uniswap as one example, right? Like started out as an AMM with only an on-chain order book. Very quickly realized this is not the most optimal way to trade tokens, but it is a big component. So now what you do like kind of OTC or like kind of, I guess intent-based transaction settlement that happens off-chain first and only goes on-chain if absolutely necessary. And I think this kind of development where like now market makers, solvers, right, kind of liquidity providers are a big part of the whole ecosystem. That's where we've already made good progress towards.
Yeah, definitely. And just to kind of keep the conversation moving towards the TradFi side, as the panel is titled, TradFi integration. What do we actually mean by this? Are we bringing DeFi to TradFi, or is it more so in the opposite direction, bringing TradFi to DeFi? And kind of how do you see that evolving and unfolding?
Yeah, so I'd say to start, it was bringing DeFi capital into TradFi, well, from a maker's perspective, and with what I talked about before, where we were needed to deploy into T-bills because we had all this excess inventory sitting in USDC, earning no yield, and the rates were going up, so it made perfect sense to go into T-bills. And so there wasn't any solutions on chain at the time, so we had to do the next best thing, which was move the funds off chain, and then deploy them into treasury bills. But now there's just been a huge explosion of options available, and the space has just matured so much. So, why are we all here? Obviously, my preference is to have everything on chain because there's just a huge number of benefits that come with that, such as the transparency, the auditability, and so we want to work towards the future where we're bringing traditional finance on chain, and just due to market efficiency increases and economic forcing functions, I think this is inevitable.
Yeah, I mean, today the market, the opportunity is like you can sell TradFi products to liquidity that exists on chain. You bring crypto native users the ability to get TradFi exposure, right? T-bills is probably, well, stablecoins was the first use case, not giving you any yield. T-bills coming next, and I think from there we'll see, like, with rates going down again and just the market maturing, more and more products that are coming. I think though also this is hopefully just the first step. I mean, surely the first step. When you look at what's been happening under the hood to make this possible, it's actually a lot of work has been done to just move more of the financial infrastructure on chain. With a lot of, actually, I remember in 2020, we would have to hedge DAI USD exchange risk. This cost us about 0.5% a year because the stablecoin DAI was so volatile that, like, on a bad day, it would be trading at 98 cents. On a good day, it's 102. Now, like, if you're lending against real estate or something like that, like, it's obviously not, you do not want to take that risk, so you start hedging it. And so that was back then, right? Like, today, on-off ramps have gotten significantly better. They're still expensive and actually a big part of, like, a big struggle in the infrastructure, even when like talking about tokenized treasury bill products, where, like, a lot of it is like getting banks comfortable with it, getting custodians comfortable with, like, where the money's coming from, where it's going, how the fund shares are managed, right, and all of this stuff. And I think that's like a place where, like, TradFi is coming closer to DeFi, and we are getting to a point where they have an understanding of what happens on chain and kind of how this could look in the future.
Yeah, there's a recurring theme of privacy, and that being a big ideal of DeFi. Will certain ideals, maybe privacy, be sacrificed kind of in this transition? You know, a bank may not want their entire on-chain position to kind of be exposed to on-chain data analysts or just on-chain sleuths in general. So do you see there being any kind of trade-off being made either from the DeFi ideal side or the TradFi integration side in making this work?
Yeah, I would say for sure. In the early days of Centrifuge, we spent a lot of time thinking about privacy. The reality is it's still not really ready to be used, I think, in production. We see more and more privacy primitives actually get to a point where you can use them, but, like, building a DeFi protocol that is fully private is extremely hard. I think just one example, like Penumbra just went live. It's a decentralized exchange that actually has a sort of dark order book, whereas on Uniswap, right, like the minute you submit your transaction, your order is public, and MEV, or, like, trading firms will try to like trade against you, right? And so, like, that is like looking at Penumbra, like the amount of advanced cryptography that they had to use, it's extremely exciting to see how far they've got with it. But like we're still quite far off from, like, that actually being usable in mainstream. So I do think, like, the reality is that for now at least, like the users that do not require that strict privacy are the ones that can use this stuff on chain, and luckily there's enough of them, right? Like, it's DAO treasuries, crypto projects, like people that can, like, hide between an exchange wallet and are comfortable with that. I think this is good enough, but yeah, in the long run, like, we do need to probably completely tear out the guts of DeFi as we know it today and actually replace it with something that does give privacy, because like, I don't want my entire financial history to be publicly on chain, and many people don't want that either.
Yeah, I completely agree. I think it's just an engineering challenge, a lot of this, and there's just been this stuff is being worked on in parallel, and there's just been, like, higher priorities. But yeah, absolutely, we do not want our personal financial history visible to everybody. That, you know, that doesn't make any sense in the long run. So I think the engineers working on this will just solve this eventually.
Yeah, and you bring in an interesting point with Penumbra. For those that might not know, it's its own app chain. So the entire blockchain's logic is just programmed to be a decentralized exchange. Do you see kind of the multi-chain and app-specific chain world kind of being an outlet for people to kind of program the specific ideals they want into their RWA product while kind of letting the greater world just kind of run off in whatever direction they might want to go in?
I think we will invariably end up in a multi-chain world just simply because the internet today doesn't run on a single computer, and I think similarly the financial system of the future will not run on a single blockchain. I think the ability to specialize in certain ways, like Penumbra is doing, like Uniswap wants to do with Unichain, I think this is extremely interesting. There are also like big technical challenges with it. Bridging being the most important one. Like you do need good communication between those ecosystems, right? Because otherwise you create separated markets that creates inefficiency and generally like a worse user experience. So really like making sure that you have cross-chain composability and really easy interaction is going to be pretty critical as we move there. Eventually we will definitely be in a multi-chain world.
Yeah, definitely like the future is multi-chain. But I think we're in this like intermediate phase where it's kind of a huge UX issue for people using DeFi right now, bridging and switching chains and all this kind of stuff. I think like even within the next year, this is going to matter a lot less. And I can talk about the things that we're working on to solve this. So liquidity fragmentation is a big issue right now, and mainly this matters for US dollars more so than anything. So at for the Sky protocol, sitting as sort of the largest broad banking system on chain versus like a Circle or a Tether, which is more of a narrow bank. As a broad bank, you're able to smooth over this liquidity issues by moving liquidity around to the different chains as we see demand for it. So the projects that we're working on, which is called the Spark Liquidity Layer, will do this in a fully automated way. So you want to use some lending protocol X on chain A or lending protocol B on chain Y. It doesn't really matter. As long as the collateral is the same, we will just smooth over this and so that the user can use whatever facility that they want, whatever interface, maybe even a centralized interface. And we will do the heavy lifting on the background to move US dollars between these chains or even within the same chain, even block by block. So eventually this whole thing will homogenize all the chains. And Sky is pretty uniquely positioned to do this just because of the excess capital in the system. So Sky is about 6 billion total deposits right now. 3 billion of that is sitting in T-bills. So compared to the size of DeFi, this is much larger. So we're going to be able to smooth out the interest rates across all of DeFi. And we're going to be rolling that out in the very near future. And on the lending side, people have the option to deposit into this relatively safe yield, which is the savings USDS, which offers a 6.5% return currently. We can outperform the treasury bill rate precisely because we have access to these opportunities in DeFi, such as crypto collateralized lending, which often pays more than the treasury bill rate. And historically, it's been a very, very safe way to do lending. And so because of this, users can deposit into this. And USDS, as the largest holder of USDC on chain, has access to this immediate liquidity when you want to exit. So as Lucas said before, some of the issues with early DAI where you don't know if it's trading above or below, $1. Now we have 1.6 billion in the highest liquidity stablecoin, which is for on-chain, which is Circle's USDC. So users have access to exit at this huge size whenever they want to. So it's this nice balance of both worlds of capturing most of the good risk-adjusted yield within DeFi and TradFi and CeFi, and then being able to exit at having this huge amount of liquidity available.
Yeah, we only have about a minute left, but the topic of composability, I think, is extremely important in DeFi today, obviously, and as RWAs kind of get onboarded into DeFi, I think it will only become even more important. With maybe our last 30 seconds here, we could give the suits some kind of take-home homework to go research. What kind of solutions do you think solve this stuff? You had mentioned Intense and solver networks. What are some other things, maybe like app-specific sequencing, base sequencing, and kind of things along those lines?
I think, I mean, the reality is right. Like assets without demand are not very attractive assets. So composability is like, how do you create demand for it, and ultimately how do you create? And typically liquidity is the best way to get to demand, because everyone in DeFi loves liquidity, and it's a 24/7 market with people loving to jump from one thing to the next in a split second. So I think what I would start with is, okay, like how do you actually build these products in a 24/7 market? Like treasury bills on chain need to have 24/7 liquidity, which is pretty awkward when you realize that on the weekends you can't actually redeem the underlying. And so I think that's like an interesting problem to solve that we will have to solve. And maybe in the long run, actually, probably a financial system is becoming a 24/7 system. I mean, in FX, it's almost a case already. But yeah, so we'll see. I think that's maybe one place I'd start looking at.
Yeah, I think we're out of time. So, like basically, like the systems such as what we're building for back-end support of liquidity at the infrastructure level, wallets, UX, all this stuff. Like I see tons of like great development happening right now, and I think we're going to pass a critical threshold like in the next year or so, where this stuff just becomes scaling as well. Like we're still not quite at like scalability to the wider world yet. So just all this stuff is being pushed on all fronts, and we will reach a critical point in the near future, I think.
Cool. Yeah, that's our time. Hope you guys were able to learn something.
Yeah, thank you.
Thank you.